Welcome to part two of our session on changes to PCAOB auditing standards brought about in the recent amendments from PCAOB release number 2022-002, Planning and Supervision of Audits Involving Other Auditors and Dividing Responsibility for the Audit with Another Accounting Firm, adopted by the Board on June 21st, 2022. My name is Andrew Cleve, and I'm an assistant in the Office of the Chief Auditor at the PCAOB and was part of the project team that worked on the amendments. The amendments strengthen the requirements and responsibilities that apply to auditors who plan and perform audits that involve other accounting firms and individual accountants by increasing the lead auditor's involvement in an evaluation of the work of other auditors and aligning the applicable requirements with existing PCAOB risk-based supervisory standards. Given the intent of this training is to provide an overview, we will not be discussing all of the nuances of the amendments, only those things that are likely to have the most significant impact for most auditors. As a result, I encourage participants to read the adopting release I mentioned earlier in order to gain a more complete understanding of the amendments. And before we get started, I'll just state our standard disclaimer that the views expressed are those of the speaker and do not necessarily reflect the views of the board as a whole, any individual board members, or other staff. In part one, we started off with the definitions created as part of the amendments. Understanding the definitions is critical to correct application of the amendments. And next we talk about planning, where we discussed, among other items, determining who is the lead auditor in an engagement that involves other auditors or referred to auditors, and planning considerations of the lead auditor when other auditors are involved. In this part two, our first topic will be supervision, where we'll be discussing the new procedures that the lead auditor should perform in order to appropriately supervise other auditors. Special considerations around multi-tier audits, including what a multi-tier audit is under the amendments, will be next, followed by the divided responsibility model when a lead auditor in its audit report makes reference to the audit report of another accounting firm, and finally we'll talk about a few certain other amendments. Note that the amendments are effective for audits of fiscal years ending on or after December 15th, 2024. First up, we'll talk a bit about supervision. As I mentioned in part one, the amendments are intended to improve the quality of audits that involve other auditors by requiring, among other things, that the lead auditor supervise the work of other auditors under AS 1201. As I mentioned previously, the lead auditor is responsible for supervision of the engagement team, and you may recall that term as defined in the amendments includes other auditors. The overall supervisory approach that applies to lead auditor's supervision of other auditors is described in existing AS 1201 and depends on the lead auditor determining the necessary extent of supervision from that standard, including taking into account the nature of the company, including its size and complexity, the nature of the assigned work for each engagement team member, risks of material misstatement, and the KSA of each engagement team member. While the lead auditor may determine the necessary extent of supervision of the other auditor's work under AS 1201, the supervision of other auditors by the lead auditor does specify certain supervisory procedures that the lead auditor should perform regardless. At a minimum, the lead auditor should inform other auditors in writing of their responsibilities. To promote effective supervision by the lead auditor, the amendments specifically require other auditors be informed of the scope of their work. And with respect to the work they've been requested to perform, the identified risks of material misstatement, tolerable misstatement, and the amount, if established, below which misstatements are clearly trivial. Obtain and review a written description of the audit procedures to be performed. As a result of this review, the lead auditor is also required to determine whether any changes to the other auditor's plan procedures are necessary and communicate them in writing. Obtain and review a written affirmation of the work performed. If the other auditor's work has not been performed in accordance with the instructions provided, the lead auditor is required to obtain and review a description of the nature of and explanation of reasons for the instances where work was not performed in accordance with instruction, including a description of alternative procedures if performed. Direct the other auditor to provide specific documentation. Supervision under existing PCAOB standards necessarily involves review of audit documentation. The standard doesn't specify which specific documentation is required to be reviewed by the lead auditor, as that will largely depend on the necessary extent of its supervision. However, this documentation, at a minimum, includes the documentation specified in paragraph 19 of AS 1215, which was largely unchanged by the amendments. And finally, the lead auditor should determine, based on a review of the documentation and above procedures, discussion with the other auditor, and other information obtained by the lead auditor during the audit, whether the other auditor performed their work in accordance with the lead auditor's instructions, including the use of applicable PCAOB standards, and whether additional audit evidence should be obtained by the lead auditor or the other auditor. Additional evidence may need to be obtained, for example, in situations in which a previously unidentified risk is identified or sufficient appropriate audit evidence has not been obtained. Before we move on to our next topic, I want to speak a bit about the necessary extent of supervision. Paragraph 06 of AS 1201 establishes the factors that the engagement partner and other engagement team members should take into account when determining the extent of supervision necessary for engagement team members to perform their work as directed and form appropriate conclusions, which includes the nature of the company, including its size and complexity, the nature of the assigned work for each engagement team members, including the procedures to be performed and the controls or accounts and disclosures to be tested, the risks of material misstatement, and the knowledge, skill, and ability of each engagement team member. And the extent of the supervision necessary will increase or decrease, though cannot be eliminated, based on these factors. For example, an engagement team member with less KSA in a particular audit area or industry will necessarily require more supervisory attention than another engagement team member with more KSA in the same area. And I'll just point out the obvious, which is that a lack of necessary supervision would constitute non-compliance with existing and amended PCAOB standards. The amendments don't make any adjustments to the factors included in AS 1201 to determine the necessary extent of supervision, but by defining the engagement team to include, for example, other auditors, that extent of supervision now applies to people captured in the definition of engagement team, including those at other auditors. This applies regardless of whether the supervision is performed by the lead auditor or engagement team members at other auditors in some cases. In that regard, the lead auditor may seek assistance from appropriate engagement team members, including those at other auditors, in performing the supervisory procedures described in AS 1201, except for certain procedures specified in the amendments. And when we say appropriate, we mean that the lead auditor must assess whether the engagement team members, whether they are at the lead auditor or an other auditor, who will be assisting the lead auditor in supervision, have the appropriate level of knowledge, skill, and ability so that they can appropriately supervise the members of the engagement team they are responsible for. And consistent with existing requirements, the engagement partner is responsible for the assignment of tasks to and supervision of such engagement team members. We have already mentioned the supervisory procedures required of the lead auditor a few slides ago, which are again noted in this last bullet. But it's important to recognize that the necessary extent of supervision may extend beyond the supervisory procedures described in the amendments. Said another way, the lead auditor may have to supervise to a greater extent than the supervisory procedures described in the amendments. Also, for the supervisory procedures described in the amendments, which are required of the lead auditor, necessary extent of supervision also applies to other considerations. For example, the extent of documentation the lead auditor will need to obtain and review from other auditors. We've already been talking about supervision, but let's talk about a special case of supervision, multi-tiered audits. While multi-tiered audits are not expressly addressed within the existing standards, in current practice, some engagement teams may be organized as a multi-tiered audit where the lead auditor does not supervise all other auditors directly. While the amendments clearly outline the lead auditor's responsibility for supervision in recognition of this current practice, there are some provisions that allow for a multi-tiered structure. But there are some specific requirements within the standard to be satisfied in order for the lead auditor to seek assistance from a first other auditor. Let's talk first about what a multi-tiered audit is. Multi-tiered audits are not defined within the amendments, but rather described as an engagement team structure whereby an other auditor assists the lead auditor in supervision of a second other auditor or multiple second other auditors. Let's compare that description of what a multi-tiered audit is with situations that may not be a multi-tiered audit under the amendments. In order to be a multi-tiered audit, the lead auditor has to seek assistance in supervising one or more second other auditors. Contrasting with that, an engagement team where the lead auditor does not seek assistance from an audit auditor and supervising second other auditors. That is, the lead auditor supervises all other auditors directly, would not be a multi-tiered audit. Even if, for example, the company itself is organized in a multi-tiered reporting or management structure. The financial reporting or management structure of the company, for example, the financial results of a location or business unit are combined or consolidated with another business unit before being consolidated by the issuer, or where there are intermediate management reporting lines, does not determine whether an audit is multi-tiered. In this regard, the organization of the company itself does not determine the audit team's supervision structure. To help illustrate a multi-tiered audit as described in the amendments, we have a figure of a typical structure. In this chart, the lead auditor directly supervises two other auditors, and one of those other auditors, a first other auditor, directly supervises two second other auditors. Because of this structure, the lead auditor indirectly supervises the two second other auditors. This typical structure of a supervision has very little to do with the financial reporting or management structure of the entity, though it is possible they could be similar. What makes up a multi-tiered audit is based entirely on the supervisory structure of the audit team. And lastly, as we mentioned earlier, only an auditor's direct supervision is considered when determining whether its participation is sufficient to serve as the lead auditor. So what is required of the lead auditor in a multi-tiered audit under the amendments? And let's preface this discussion with the caveat that the lead auditor's use of a first other auditor is entirely within the lead auditor's discretion, and the lead auditor must make that decision for all other auditors involved in the audit. Firstly, the lead auditor has to determine whether it is appropriate for a first other auditor to supervise one or more second other auditors. This determination is based on the same extent of supervision that applies to the engagement team as a whole. A first other auditor has to be able to perform their work as directed and form appropriate conclusions with regard to supervising second other auditors, given the facts in existing AS 1201 paragraph 06. If, for example, a potential first other auditor does not have appropriate KSA in order to supervise a potential second other auditor, or the potential second other auditor's scope of work includes fraud risks that require the lead auditor's attention, it may not be appropriate. These examples are provided for illustrative purposes, and there could be other situations where the necessary extent of supervision requires the lead auditor's direct supervision. If determined to be appropriate, a lead auditor may seek assistance from a first other auditor in performing the supervisory procedures included in the amendments that we discussed earlier. This could include, for example, informing a second other auditor of the scope of work to be performed, obtaining and reviewing the second other auditor's written description of audit procedures to be performed, determining whether any changes to the second other auditor's planned procedures are necessary and communicating them in writing, and reviewing audit documentation of a second other auditor. However, there are certain procedures that the lead auditor should perform in order to discharge their responsibility for supervision of the engagement team as a whole. We've already discussed that under the amendments, the lead auditor is responsible for supervision of the engagement team. In applying this overarching responsibility to the concept of multi-tiered audits, this extends to a first other auditor's supervision of second other auditors. As part of this, the lead auditor should evaluate whether a first other auditor has appropriately supervised one or more second other auditors. This would also require that the scope of a first other auditor's supervision be communicated to a first other auditor as part of their scope of work. Like all supervision, the actual procedures performed by a lead auditor to appropriately supervise a first other auditor's supervision of one or more second other auditors will be based on the necessary extent of supervision. Another is that the lead auditor should obtain, review, and retain documentation that identifies the scope of work to be performed by the second other auditor. Further, the amendments clarify that for purposes of complying with AS 1215-19, a lead auditor may request that the first other auditor obtain, review, and retain the second other auditor's documentation that is required by AS 1215.19, then incorporate that information into their own documentation provided to the lead auditor. Ultimately, the lead auditor should take into account a first other auditor's supervision of a second other auditor when determining the extent of its own review of a second other auditor's documentation, if any. Some other considerations related to multi-tiered audits. The first one relates to determining sufficiency of participation, which was one of the first topics we talked about on planning. We mentioned this earlier, but the rule includes a provision when determining sufficiency based on extent of supervision that second other auditors supervised by first other auditors are not included in that determination. If you recall, we said the intent of the sufficiency of participation determination is that the lead auditor participate in the audit as a whole to a meaningful extent, and that one of the goals of the rulemaking was to ensure that the lead auditor is responsible for appropriate supervision. The caveat for extent of supervision in multi-tiered audits is intended to ensure that potential lead auditors are appropriately supervising the engagement team to that meaningful extent. Generally, while a first other auditor may assist the lead auditor in planning the audit and supervising the work of one or more other auditors, that does not extend to planning activities required in the amendments to AS 2101. However, there are some activities where a first other auditor may assist the lead auditor. Those are with regards to 1, the lead auditor's determination of a second other auditor's compliance with SEC independence and PCAOB independence and ethics requirements, and 2, the knowledge, skill, and ability of and communications with second other auditors. With regards to independence and ethics, the amendments still require the lead auditor to make that determination, but a first other auditor can inform the lead auditor of the results of procedures performed. And the last issue with regard to multi-tiered audits is whether the requirements translate to further tiers, which was a situation that was raised by a few commenters during the rulemaking process. The amendments are focused on the planning and supervision responsibilities of the lead auditor. Other requirements of PCAOB standards apply and would continue to apply under the requirements to all auditors involved in the audit. For example, in determining the necessary extent of supervision of a third other auditor's work, a second other auditor would be required to take into account items listed in AS 120106, including the nature of the work assigned to the third other auditor, the risks of material misstatement, and the third other auditor's knowledge, skill, and ability. Next on our agenda is a discussion on the changes to the divided responsibility model in which a lead auditor makes reference to a referred to auditor in the lead auditor's report for the audit of the financial statements and, if applicable, ICFR. The divided responsibility model is not new under the amendments, being a possible outcome under the currently existing AS 1205. In a divided responsibility audit, the principal auditor uses the work and reports of another auditor, making reference to that referred to auditor in their own report and effectively dividing the responsibility for the audit as a whole. Divided responsibility audits are relatively uncommon, with approximately 40 audits per year with responsibility divided. This approach is typically used in situations in which it would be challenging for the lead auditor or principal auditor, using current terminology, to supervise the referred to auditor directly. Given this, a new standard, AS 1206, dividing responsibility for the audit with another accounting firm, was included in the amendments to retain the approach while introducing certain improvements. We'll examine some of these changes in the next few slides. But before we move on, I'll just quickly note that the number of divided responsibility audits noted in the slide is based on Form AP filings from 2018 to 2021. A few conditions that are prerequisites in order for the lead auditor to divide responsibility with a referred to auditor are that the lead auditor should determine that the audit procedures are performed in coordination with the referred to auditor to test and evaluate the consolidation or combination of the financial statements of the business units that are audited by the referred to auditor. These are items that are typically not in scope of the referred to auditor's report, such as elimination of intercompany transactions. The lead auditor should communicate the plan to divide responsibility to the referred to auditor in writing pursuant to PCAOB standards. This is required so that the referred to auditor can take the necessary steps to ascertain the implications of participating in the audit. For example, compliance with PCAOB auditing standards and inclusion of the referred to auditor's report in the issuer's filing as required under SEC rules. The lead auditor should obtain written representations from the referred to auditor that the referred to auditor is independent of the audit client under the requirements of the SEC and PCAOB, and that the referred to auditor is duly licensed to practice under laws of the jurisdiction that apply to the referred to auditor. In addition to the required procedures the lead auditor should perform, certain conditions are required to be met in order for the lead auditor to divide responsibility for the audit of the financial statements and, if applicable, ICFR. First is that the lead auditor obtains representation from the referred to auditor that it has performed the audit and issued the auditor's report in accordance with PCAOB auditing standards. Next, the lead auditor has determined, based on inquiries made of the referred to auditor and other information obtained by the lead auditor, that the referred to auditor is familiar with the relevant requirements of the reporting framework, standards of the PCAOB, and reporting requirements of the SEC. Third, that the referred to auditor is registered with the PCAOB if it is required to be under the rules of the PCAOB. And lastly, in situations in which the financial reporting framework of the issuer and the company's business unit audited by the referred to auditor differ, either that the lead auditor or referred to auditor has audited the adjustments to convert the financial statements of the business unit into the financial reporting framework of the issuer, and that the lead auditor includes in its report which auditor took responsibility for those conversion adjustments. If any of the conditions to divide responsibility are not met, the lead auditor may not divide responsibility for the audit with the referred to auditor. In that case, let's talk about what options are available to the lead auditor. On the off chance that the lead auditor is unable to divide responsibility, there are essentially three courses of action included in the standard when the lead auditor originally planned to divide responsibility with a referred to auditor, but subsequently determined that was no longer possible. The first, and most likely, is for the lead auditor to find another possible way to plan and perform procedures with respect to the business unit of the company. The first course of action is probably going to be the most common given the implications of the other two. This first course of action is left intentionally open and doesn't require a particular approach, only that the lead auditor find an alternative approach. This could include employing another auditor under the amendments to be supervised directly by the lead auditor, or the lead auditor performing the necessary procedures themselves. The other two courses of action are to appropriately qualify or disclaim the lead auditor's report or withdraw from the engagement. In situations in which the lead auditor cannot divide responsibility with one referred to auditor, it's important to recognize that the lead auditor may alternatively find another referred to auditor to perform the work where the conditions have been met. Next, let's talk about how the lead auditor reports when dividing responsibility for the audit. There are some enhancements that were made to the lead auditor's report when dividing responsibility with a referred to auditor. The first is an existing requirement that the lead auditor's report clearly indicate that responsibility has been divided for the audit of the financial statements and, if applicable, ICFR, which is an enhancement. The second is a new requirement that the referred to auditor be identified in the lead auditor's report by name. This is in addition to the existing requirement to refer to their audit report. The third is an existing requirement to disclose the magnitude of the company's financial statements and, if applicable, ICFR, which is an enhancement audited by the referred to auditor. This can be done by stating either dollar amounts or percentages of total assets, total revenues, or some other appropriate criteria that identifies the portion of the financial statements that the referred to auditor was responsible for auditing. And lastly, a somewhat new requirement, though our research shows in practice this is how the large majority of lead auditors are reporting, is for the lead auditor to include each of the above items for each referred to auditor in their report. Our staff analysis of divided responsibility audits showed very few audits where more than one referred to auditor was utilized. In almost all of those situations, our analysis has shown that all of those included the currently required disclosures for each auditor by disaggregating them. And lastly is a requirement of the lead auditor to make reference to any other than qualified opinions or any explanatory language included in a referred to auditor's report, unless clearly trivial. This requirement was intended to increase the transparency to users of the lead auditor's report of issues at the business unit audited by the referred to auditor that are relevant to them. Before we close out this section, I'll also mention there are several examples of language to be included in the lead auditor's report included with Appendix B of the new AS 1206. Before we close out the session, there are just a few other revisions I'd like to bring up. The first is with respect to audit evidence based on the audit report of an investee, for example, equity method investments. Under paragraph 14 of AS 1205, the auditor who issues the audit report on the investor may be in the position of a principal auditor. The amendments integrate some of those considerations into paragraphs B1 to B2 of AS 1105, which describe the auditor's responsibilities for obtaining sufficient appropriate evidence in situations in which the valuation of an investment is based on the investee's financial results. Under the amendment requirements, the investor's auditor would be able, where appropriate, to use the work and report of the investee's auditor. Next is an amendment to AS 1215 that applies specifically to other auditors. Under the existing requirements in paragraph 18, the office issuing the auditor's report is responsible for ensuring that all audit documentation sufficient to meet the relevant requirements is prepared and retained. An amendment to this paragraph reinforces that with respect to work performed by the other auditor must comply with existing documentation requirements in AS 1215, specifically paragraphs 4 through 17, including with respect to documentation provided to the office issuing the auditor's report. In this regard, an other auditor participating in the audit is required to retain a complete set of documentation with regards to the work it performed. And lastly, are amendments made to the engagement quality reviewer involvement. Specifically, due to the significance of the determination, the EQR will now be required to evaluate the engagement partner's determination that it can serve as the lead auditor. That is, the engagement partner's participation is sufficient. In addition to what's on the slide, there were also some additional conforming amendments made to various standards, including AS 1301, Communication with Audit Committees, AS 2401, Consideration of Fraud in a Financial Statement Audit, and a few others. The amendments were largely to carry forward current requirements or new terminology into existing standards. With that, this concludes this presentation and some of the changes coming about as a result of the rulemaking on other auditors. I'd just like to say thanks for listening. And for more information on the amendments and the rationale for the changes, please see the adopting release from June 2022, which is PCAOB release number 2022-002.